Interest rate risk in banking. Strategies to manage with asset liability management. Interest rate risk is a significant concern for banks. It arises from the change in interest rates that can affect a bank's profitability and capital. Understanding and managing this risk is crucial for maintaining financial stability. What is interest rate risk? Interest rate risk is the potential impact that changes in interest rates can have on a bank's earnings and economic value. When interest rates rise or fall, it can affect the bank's assets, such as loans and investments, as well as its liabilities, like deposits and borrowed funds. This can lead to a mismatch in the timing and amounts of cash flows, ultimately influencing the bank's bottom line. Understanding asset liability management, ALM. Asset liability management, or ALM, is the process that banks use to manage the risks that arise from mismatches between assets and liabilities. ALM takes a comprehensive approach to balance both sides of the balance sheet, ensuring that the bank can meet its financial obligations while maximizing returns. It involves analyzing the structure of assets and liabilities, forecasting interest rate movements, and developing strategies to mitigate risks. Strategy 1: Gap analysis. One effective method in ALM is gap analysis. This involves monitoring the timing of interest rate changes and their impact on assets and liabilities. The bank identifies periods where there's a gap between the repricing of assets and liabilities, which can help assess exposure to interest rate risk. By strengthening the timing of cash flows, banks can position themselves to benefit from favorable interest rate changes while minimizing potential losses during adverse movements. Strategy 2: Duration analysis. Duration analysis is another important tool in managing interest rate risk. It measures the sensitivity of the price of a financial asset to changes in interest rates and helps in understanding the potential changes in the economic value of assets and liabilities. By evaluating the duration of both sides of the balance sheet, banks can make more informed decisions. They can align the duration of assets with that of liabilities to reduce the risk of market fluctuations negatively impacting their value. Strategy 3: Interest rate swaps. Interest rate swaps are financial derivatives that can help banks hedge against interest rate risk. By entering an agreement to exchange interest rate cash flows, banks can transform the structure of their interest rate exposure. For instance, if a bank has a considerable amount of fixed-rate assets, it may buy a floating rate swap to convert some of that exposure. This strategy can enhance the bank's ability to withstand interest rate fluctuations. Strategy 4: Diversification of asset classes. Diversifying asset classes is a prudent approach to managing interest rate risk. By spreading investments across a variety of asset types with different sensitivities to interest rates, banks can reduce the overall risk. For example, investing in fixed income securities, variable rate loans, and alternative investments can ensure that not all assets are affected similarly when interest rates change. Strategy 5: Liquidity management. Effective liquidity management is essential in mitigating interest rate risk. Maintaining ample liquidity allows banks to react quickly to changes in interest rates without significant disruptions. This can involve holding liquid assets, ensuring adequate cash reserves, and establishing credit lines for flexibility. A strong liquidity position can help banks navigate rate fluctuations more effectively. Conclusion. In conclusion, interest rate risk is an unavoidable aspect of banking, but with robust asset liability management strategies, banks can effectively manage this risk. By utilizing gap analysis, duration analysis, interest rate swaps, diversifying asset classes, and maintaining liquidity, banks can create a resilient financial framework. This enables them to adapt to shifting interest rates while safeguarding their profitability and capital. Understanding these strategies will help financial professionals navigate the complexities of managing interest rate risks in today's dynamic banking environment. Ready to elevate your treasury expertise? Become a Global Banking Hub member to access exclusive courses, earn certificates, and get personalized feedback. Join now at www.globalbankinghub.com.